flour, sugar, and fuel. Three basic commodities whose prices have since January this year skyrocketed, contributing significantly to the high cost of living. And as if that is not enough, the wave of loan offers that hit the market 2 years ago, opening opportunities for development for both individuals and corporate bodies, may now come to haunt those who seize the opportunity to take up bank loans. Interest rates are on their way up. After the central bank started pursuing a policy of increasing interest rates to limit money supply and tame runaway inflation 3 months ago, more than 10 banks have adjusted their lending rates from an average of 15% to up to 19%, making it more expensive and difficult for customers to acquire loans. In a country where interest rates rise with each beating the economy takes, not many Kenyans can afford to take loans, and those who do are faced with higher rates of default, a situation which not only threatens economic growth, but the financial well-being of the very Kenyans who need it. For instance, a loan of 1 million shillings payable over 5 years at a 15% interest rate per year would see a borrower pay the bank 1.42 million shillings. But at the new rate of 19%, borrowers will now pay an additional 140,000 shillings, bringing the total payment to 1.56 million shillings. Rangwe Member of Parliament Martin Ogindo has already moved a bill in Parliament seeking to peg interest rates at not more than 4 percentage points above the prevailing central bank rate, which currently stands at 11%, meaning that should the bill become law, banks can only charge interest at a maximum rate of 15% at the moment.
My bill seeks to regulate the price of money. And money is a basic commodity and a very necessary commodity for everyday life. As a result, money needs to be affordable.
If adopted, Ogindo's proposal will also force banks to give customers better interest rates on deposits, significantly reducing the gap between what they charge borrowers and what they pay savers, known as the interest rate spread.
Commercial banks have been exploiting their depositors. Why do you take a depositor's money and pay 1.5% interest and lend it out at 18% interest?
Ogindo's bill is an improvement of the Donde Bill of 2001 in that it proposes to benchmark regulated interest rates using the central bank rate rather than the treasury bill rate, but it is likely to meet stiff resistance from the commercial banks, as it will also restrict them from receiving loan repayments that total more than the principal borrowed, a part of the Donde Bill that was adopted but is not thought to be strictly adhered to in the credit markets. On the other hand, it may stimulate growth in savings through more attractive returns, boosting a section of the financial sector that has remained suppressed due to lack of incentives to save. Wanjiru Gaido, Citizen Weekends.